If you've ever looked at a stock chart, I bet you've had the thought, what if there was a secret formula, some hidden set of rules that could turn all that market chaos into just predictable, massive profits? Well, today, we're putting one of the most famous secret formulas ever created to the ultimate test.
I mean, just think about that for a second. A literal recipe for getting rich, handed to you by one of the masters. It sounds like something out of a movie, right? But back in the 1980s, this was a real-life experiment, one that created an absolute Wall Street legend, the legend of the turtle traders.
All right, so let's get into it. To really get why this strategy became so mythical, we have to go right back to the beginning, to its almost unbelievable origin story. And it all started with this idea, this quote. It came from a bet between two famous traders, Richard Dennis and William Eckhart. See, Dennis had this radical belief. He argued that great traders weren't born with some special gift. He believed they could be made, that you could teach them, systematically. He basically set out to build a trader factory.
So picture this, it's 1983. Dennis puts out an ad and recruits a bunch of total novices. We're talking everyone from a blackjack player to a security guard, and he gives them his secret set of trading rules. He called them his turtles. And the results? They were absolutely astonishing. The story goes that they made over $100 million. And just like that, the turtle trading rules became the stuff of financial folklore.
Okay, so if we're going to put this legend to the test, we first need to pop the hood and see what's going on. What were these secret rules? What was in the magic recipe?
Well, at its core, the whole thing is about something called trend following. The goal isn't to be a genius and predict the future or to perfectly time the market, buy low, sell high. Nope, it's way simpler. You spot a powerful trend, you jump on, and you ride that wave for as long as you possibly can, no matter if it's going up or down.
So the big question is, how did they know a trend was actually starting? Well, they had one key signal they looked for, called a breakout. Imagine there's a ceiling at the highest price a stock has hit in, say, the last month. If today's price suddenly smashes right through that ceiling, that's a breakout. For the turtles, that was the big green light. It was the signal that a new uptrend might be starting, and it was time to buy. And of course, the same exact logic worked in reverse for betting on prices going down.
The entire system was this super rigid mechanical recipe. Step 1, watch for a breakout. Step 2, when it happens, you trade. No hesitation, no second guessing. Step 3, you use a very strict formula to manage your risk. And Step 4, you get out only when another predefined signal tells you to. The whole point was to completely remove human emotion, fear, greed, all of it, from the trading process.
So you've got this simple, powerful system that apparently worked wonders in the 80s. But here's the million-dollar question, right? Can this 40-year-old legend survive the absolutely brutal, high-speed, computer-driven markets of the 21st century?
To find out, we're diving into a 2022 thesis from Sweden's KTH Royal Institute of Technology. A group of researchers there decided to stop treating the turtle rules like some old story and start treating them like a science. They put the whole system through a rigorous, modern stress test.
And their method for doing this was just brilliant. They ran a two-part test. First, they let the turtle rules loose on 20 years of real-world data from major stock indexes. But then, and this is the clever part, they also tested the rules in a perfect computer-generated world, a simulated market with these beautiful, clean, predictable trends, just to see how the strategy should work if the world was ideal.
All right, this is it, the moment of truth. The legend, the secret code, and the modern test are all about to collide. Let's see what happened when the turtle rules came face-to-face with reality.
This is the only question that really matters. After all this time, after 4 decades, did the turtle strategy still work? Was it still making money?
The answer? Well, you can see it for yourself, is a resounding, spectacular no. What's so amazing about this chart is just how clear the result is. That rising orange line, that's what you would have made by just buying the market and holding on. And that blue line, you see it down there, flatlining at the bottom, that's the turtle strategy. It's a pretty brutal picture.
So let's put a hard number on that flat blue line. Over 2 decades, the study found that the turtle strategy produced an average annual return of just 1.4%. And get this, that's before you even account for trading fees, which would have almost certainly pushed the final result into the red. So the conclusion from the researchers was crystal clear and totally definitive. The legendary turtle trading strategy, in its original form, is just not viable in today's financial markets. The legend? Well, it's officially busted. And that brings us to what is, for my money, the most important part of this whole thing. I mean, it's not enough to just know that it failed. We need to understand why. What broke?
The researchers basically pinpointed one core problem. The rules couldn't tell the difference between a real signal and just random market noise. The strategy was built to find these beautiful, clean, obvious trends. But modern markets? They're full of noise, choppy, unpredictable, short-term movements that look like a trend is starting but then just fizzle out and go nowhere.
And this created a whole cascade of failures. The breakout rule was getting triggered all the time by these false alarms, tricking the system into buying into noise. Then, on the rare occasion it did make a little profit, the exit rules were too slow to actually lock it in. The bottom line is, the very thing the system needed to survive, those long, smooth trends, might just not be as common anymore.
And this right here perfectly illustrates the problem. On the left, you've got a real market chart. It's a mess, it's chaotic, it's noisy. On the right, you've got that computer-generated perfect world with clean, predictable cycles. The turtle strategy was designed for the world on the right, but it was forced to live in the world on the left.
And the difference in performance is it's staggering. In the real, noisy world, the strategy earned that tiny 1.4%. But in the perfect, simulated fantasy land, the study showed it could produce returns as high as 354%. It just proves the rules could work in theory. The problem is, reality just refused to cooperate.
So, after all that, after completely busting a legendary myth, what's the big picture lesson for us? What should you actually take away from all this? I think the lesson is actually pretty simple, but it's incredibly powerful. Markets evolve. A strategy that worked like magic in the slower, less chaotic world of the 1980s can become totally obsolete. An old treasure map might not lead you to gold if the entire landscape is changed.
And that leaves us with one last provocative thought. We all love the idea of a secret formula. But if one of the most famous, most celebrated secret strategies in history can fail this completely, maybe the best strategy isn't a secret at all. Maybe it's something much simpler, hiding in plain sight.